Gold, often seen as a safe haven, has a fascinating history of price fluctuations. Today, we'll delve into the intricate factors that drive these movements, from global events to policy decisions. Gold price fluctuates due to supply and demand dynamics. When demand increases, prices rise. This surge in demand can be triggered by economic uncertainty when investors flock to gold looking for a safer asset. Let us look at some macroeconomic events that can trigger the principle of supply and demand, thus affecting gold prices. The first one is inflation. High inflation can drive demand for gold because inflation erodes the purchasing power of currencies, and gold can retain value better than fiat currencies. However, gold's supply is relatively inelastic, meaning it doesn't fluctuate significantly in the short term. When demand decreases, often during times of economic stability and low inflation, prices can fall. The second macroeconomic factor is interest rates. Interest rates and gold prices often have an inverse relationship. When interest rates are low, traditional investments like bonds offer lower returns. This can drive investors towards gold, which is seen as a safe haven asset that can retain its value. As demand for gold increases, its price rises. Conversely, when interest rates rise, traditional investments become more attractive, reducing the demand for gold. Another major macroeconomic factor is currency fluctuations. The strength of a currency also influences gold prices significantly. When a currency weakens, the purchasing power of its holders decreases. As a result, investors may turn to gold, considering gold is a safe haven asset in order to preserve their wealth. Increased demand for gold can drive its prices higher. Conversely, a strong currency can make gold more expensive for foreign buyers. Now, this can reduce demand and potentially lead to lower gold prices for domestic buyers. So, this was part one of trying to understand how gold prices fluctuate based on certain economic factors. Let's delve into some of the major historical events that have shaped gold's price trajectory. We're going to look into past 100 years, how gold prices have fluctuated. The Great Depression was a severe worldwide economic depression which started in 1929 and went on till 1941. The Great Depression saw a surge in gold demand as investors sought a store of value amidst economic turmoil. Governments too hoarded gold to stabilize currencies. Now, because of this hoarding, the gold prices went up. World War II, 1939 to 1945. Soon after the Great Depression, World War II started, and the nations involved in the war required substantial funding to support military operations, production of war materials, and economic mobilization. Gold, as a universally recognized asset, was used to finance these efforts. The war ended in around 1945, and during the same time, we see the introduction of the Bretton Woods system, introduced in the year 1944. Post-war, the Bretton Woods system, pegging currencies to gold, brought relative stability to the world economy. The system, though initially stabilizing, eventually faced strain due to the US dollar's increasing role in international trade. Then comes the Nixon shock and the end of the gold standard. In 1971, the US abandoned the gold standard, ending the dollar's convertibility to gold. This pivotal moment unleashed gold prices, allowing them to fluctuate freely based on market forces. The Cold War and geopolitical tensions between the United States of America and Russia also played a very important role. The Cold War era witnessed a strategic accumulation of gold reserves by the US as well as the Soviet Union. Geopolitical tensions and the nuclear arms race fueled demand for gold as a hedge against uncertainty. The 1970s oil crisis. OPEC's oil embargo triggered stagflation. Now, OPEC is the Organization for Petroleum Exporting Countries. So in 1970s, they had an embargo, and this embargo triggered stagflation. Stagflation is basically a period of high inflation and high unemployment. Because of this oil crisis, investors again turned to gold as a hedge against inflation, driving prices higher. So you can see in the graph also how during the 1970s there is a jump in gold prices. The financial crisis of 2008. This crisis eroded confidence in traditional financial instruments. Central banks implemented quantitative easing, expanding their balance sheets and devaluing currencies. Again, gold was the tangible asset. It gained appeal as a hedge against inflation and currency devaluation. And finally, the COVID-19 pandemic. Economic lockdowns and unprecedented fiscal stimulus measures led to concerns about inflation. People thought that inflation might come. Now, because of this, gold, historically a reliable inflation hedge, saw a surge in demand once again. In recent decades, the influence of various factors on gold prices has become even more pronounced. Monetary policies implemented by central banks, such as interest rate adjustments and quantitative easing, can significantly impact gold's appeal. Low interest rates and quantitative easing often lead to increased demand for gold, as investors seek to hedge against inflation and currency devaluation. Central banks themselves can be a major player in the gold market. When central banks accumulate gold, it signals increased confidence in the metal. Conversely, selling gold can dampen the demand. Finally, investor sentiment plays a crucial role. News, economic data, and market trends can significantly impact investor sentiment towards gold. News such as concerns about inflation or geopolitical instability can drive up demand and prices. Conversely, news such as stronger economic growth or lower inflation expectations can dampen demand and lead to price declines.